Eoin McGee here, just off Ciara Kelly on Lunchtime Live, and the questions we didn't get to on air, we're going to take them now on Facebook Live because it's Thursday and that's what we do on Thursdays. So any money questions, we have a few to get through, probably space for maybe one or two more, so do get the questions in and we will get through them as best we can. So up with the first question.
Okay, so we're starting with a bit of a long one, but just bear with me, okay? So my siblings and I are being left our family home. My father is terminally ill at the moment and he wants my husband and I to live in it with our children when the time comes. However, my siblings want their share, understandably. So the only way for this to happen is for us to purchase it at market value. We already have our own place, which is approximately 20 grand in positive equity. However, we have no deposit in cash. I've gone to 2 banks asking would the fact that I have a share in the house count towards the deposit element for the mortgage, but neither agreed. Any advice would be really appreciated.
I actually just think you've gone to the wrong 2 banks. I'm sorry to hear about your dad, by the way. That's tough going, and these are difficult financial decisions to be making at a time with other stuff, emotional stuff going on like that. But I would think that the 2 banks you've gone to have just are looking at it in the wrong way. It depends on how much a percentage. I'm not sure exactly how many siblings you have or how many people are going to have ownership in this house, and that it's going to have to be shared amongst them. But your portion of the house is a contribution to the overall cost of the purchase of the house. And ultimately, all the bank is interested in at the end of all this is what's the loan to value. And what I mean by loan to value is what percentage of the house is mortgaged up. So if the house is worth €100,000 and you have €80,000 of a mortgage on it, that's 80% loan to value. And they want to make sure that the loan to value numbers work. Now, you'd be considered a second time buyer, so you're going to have less than 80% loan to value. I would suggest in a difficult time like this, the best place to go is go talk to a mortgage broker, find a decent one that is able to give you the advice and say, okay, this is the bank that is the right bank to go to with this proposal. I wonder though, in terms of I think you mentioned that you are in positive equity, but maybe the equity in your own home isn't enough. And I wonder, just question whether it would be a good idea to sell on that house and buy this one or not. I don't know enough about you to be able to give you that advice. What I would say though as well is that these are big decisions to be making at a difficult time, and just make sure that you're making them in the right frame of mind is what I'd be asking you to do. But go talk to a broker.
Okay, so somebody wants to know, do you think we're gearing towards a recession again, as an article in the Irish Times said it was 100% coming?
Okay, so the head of the NTMA last week was quoted as saying, he was asked a question, is there a recession coming? And he said 100% there's a recession coming. Let's just take that headline and take it apart a little bit. We are 100% coming up to a recession always, because there's always a recession at some stage in the future. It's a little bit like if he was asked, do you think you're going to die at some stage in the future? He would say, 100% I'm going to die at some stage in the future. It's the same thing. So recessions are cyclical. What happens is that the economy corrects itself a little bit and then it goes up again, then it corrects itself a little bit and goes up again. So it's always going up and down, but it's always on an upward trend. Are we talking about having another 2008 again, 2009, 2010? Who knows? But the reality is we know from stock markets and what shares do, and shares are a reflection on the economy and what the recessions look like, is that every 3 to 5 years we have a minus 31% on shares every 3 to 5 years on average. So if you think about that, we are always facing into a recession at some stage in the future, and there's a 100% chance of a recession at some stage in the future. In the same way, there's a 100% chance you're going to die at some stage in the future. So look, how do you make your decisions around these things when it comes to investing, when it comes to buying homes? You take a very long-term view and you expect these things to happen, and you don't worry, you don't sweat the small stuff. And that's how you get over these things. Who knows where we're going, but we do know we're going to have a recession and we're going to have a boom and we're all going to die at some stage too.
Okay, so this is pretty simple. So any tips for getting better with money? I have about 800 a month disposable income left once I clear everything, and I never seem to have a penny the week before payday. Why?
That's because of Parkinson's law. This is what you're getting caught out with. So what you're saying is you're covering off all your bills, you've 800 quid left, and there's 2 things. You need to do a little bit of planning. You need to say, well, last month and the month before and the month before, what did I actually spend that 800 quid on? It sounds like you haven't got a clue what you spent it on, and that would suggest to me that Parkinson's law has kicked in. What Parkinson's law is that if you have a job is going to take the amount of time you have to do it. So if you have an hour to cut the grass, it's going to take an hour to cut the grass. If you've got 3 hours to cut the grass, you're going to have 3 hours to cut the grass. It's going to take you 3 hours to cut the grass. If you earn 100 grand a year, you're going to spend 100. If you earn 200 grand a year, you're going to spend 200 grand a year. If you have 800 quid left over at the end of the month, after you paid all your bills, you're going to spend 800. If you've got 1,000, you would actually spend 1,000 and you still wouldn't know where it's going. So what you need to do is you need to give a job to that 800 that's left over, because you're being good, you're getting your bills done, you're leaving yourself with 800 euros, Parkinson's law is kicking in, you're losing all that 800 quid. Give yourself a job that says 800 quid, 200 of that is going to go on Christmas, 200 of that, or I'm making these numbers up to be simple, 200 of that is going to go on next year's holidays, 200 of that is going to go to my car insurance, and 200 of that is going to go on my entertainment. Don't stick to the numbers, make up your own ones. But you see the point I'm making. Give the money a job and then it'll do what it's told. Don't give the money a job and you'll just spend it on random stuff that you probably didn't need and you won't remember anyway.
Okay, so why are mortgage rates so much higher in Ireland compared to Europe?
God, why are mortgage rates higher in Ireland than compared to Europe? There's lots of excuses. There's no real reason. So the excuses that we're given all the time is that our banks were in serious difficulty and they may need to make serious profits in order to recover from the difficulty. There's also the excuse that repossession in Ireland is considered much higher. I think I heard a figure last week that we've had 1,300 homes repossessed in the last 4 or 5 years in a really difficult time. There's been 1,300 homes, and for those 1,300 people, that was a horrible experience to go through. And the banks would argue that because we find it so difficult to repossess houses, it's much harder to factor in the default rate, and therefore they have to charge us. The real answer is probably because they get away with it. And they have been getting away with it for so long. And it can be in and around 2% more expensive to borrow money here than if we all had been born in Germany and we were borrowing money on mortgages over there. And that's a lot of fat in the difference. And it's not right. It doesn't make sense. But what's the reason? Not so sure. But there's lots of excuses there.
Okay, hi Eoin, I just want to get your advice on something. So I've been saving $850 a month comfortably for my mortgage deposit. I've now hit my deposit and my actual mortgage is $650 a month. I want to get a home improvement loan so I can furnish my house all at once, and the loan repayment comes in at about $200 a month. I feel I can afford to get this loan on top of my mortgage, but I always hear bad things about taking loans out. What do you think?
So it sounds like you're not actually in the house yet. You've got the deposit, you've worked out what the loan repayment is going to be on the mortgage, and you're thinking about moving in, using up all of your savings, which is hard got, and then getting out a new loan. So what you're going to do is you've moved so far forward, you're going to buy the house, wipe yourself out, and then you're going to go backwards by getting the loan out. Any chance you might just hold on another few months and keep saving and then have the money together to get the loan, that you don't have to get the loan, you can do the home improvements or furnish the house or whatever it is you need to do. Ultimately, what I would say to you is that you don't want to get that loan approved or even go and apply for it before you go for the mortgage. The mortgage needs to be drawn down and then consider your position. I wonder, is there any, like, you have done so well. You've done everything right. You've worked out at $650 as the loan repayment. You've saved more than that to prove to the bank that you've got a great ability to repay. You've got to deposit. You've done everything right so far. And now you're going to set yourself up on the back foot as soon as you move into the house. Any chance you could push back buying the house, which is a difficult thing to do completely, and there's lots of other factors that come into that, or maybe do the work a little bit slower and just save your €200 a month and see if you can do it that way instead. If you've got to do it, you've got to do it. If the house isn't habitable, what can you do about it? But you're just doing so well. It's horrible to hear that you're about to put yourself in negative at such a good time when you've done so well with everything else.
Okay, so what % of your wages would be good to save?
So we actually had a similar question to this on air when I was on with Ciara a little while ago. What I would say is 10% of your money will put out the fires when things go wrong. So if you earn €1,000 a month and you save €100 a month of that, you will start to put out the fires, or these things that are inevitable that we all see as surprises. Somebody actually said the other day, when I'm trying to get through the week and like things happen, like the weekend. A weekend happens every week. It's not a surprise, right? So what I would say is that 10% kind of puts out fires depending on your income. 15% and you're now starting to get ahead. You save 20% or more of your take-home pay on a month-to-month basis, and that's when you create real wealth. Like any of my clients who have built up large sums of money over long periods of time, they're saving 20-25% plus of their take-home pay. Now, they're in a good position because obviously they're not spending 55% of their money paying rent and leaving themselves completely short. And that's why paying 50-55% rent, particularly in places like Dublin at the moment and Cork and Galway, it's the inevitable, and if you want to rent, that's what you're paying, but you're storing up serious problems for the future. So the answer, in simple terms, how much should you save? 10% if you want to just put out fires, 15% if you want to start to get ahead, and 20% plus if you really want to create wealth. It's a difficult one to achieve, but the other thing I'd say to you is start at 10%. If you don't even start at 10%, start at 2%, and every month increase it by 1%. It'll make a massive difference.
Okay, so do you know what a HELOC loan versus a traditional mortgage is?
Okay, HELOC doesn't seem right. It could possibly be HELOC, H-E-L-O-C. I know. Okay, let's assume it's that sounds like a home equity line of credit. That's what it is, home equity line of credit. I thought it was just a US thing. Maybe it's starting to come in here. It's news to me if it is. So a standard mortgage is you borrow the money and they tell you we're giving you 200,000 euros or 300,000 euros and you're going to pay us back X amount of money every month, and at the end of 20 years or 30 years the money will be all paid back. With a HELOC loan, it's a slightly different. It's a line of credit. So they say to you, what we're going to do is we're going to approve you for like 200,000 euros and you can draw down out of it whatever you want to draw down. So you might draw down 50, you might draw down 100, but it's always there in the background and you pay it off as you go along. The HELOC loan would tend to be you've already got a mortgage and there's equity in your house, so there's value in your house that's not mortgaged up, and they will give you a percentage of that as just a line of credit. It's a bit more flexible. In terms of rates, you'd have to check in the rates because particularly when I'm not actually familiar with what happened here in Ireland, so I would just wonder where this person is getting these numbers from, because if it's from a Google search, I think you might struggle in Ireland to get someone to do that for you.
Okay, so this comes in from John. So is an AVC a good form of secondary pension?
Any form of pension is a good form of pension. So an AVC, what that means is that John would have a main scheme, as we would call it. So he has an employer, or maybe he is the employer, but he's paying into a company pension scheme already, and he might be putting money into it, the employer might be putting money into it, and now he wants to put a bit extra in. The first thing you need to make sure of before you start putting money into AVC is, are you maxing out what you're doing with your employer? So sometimes you might put in 5%, let's say, and they might match that with 5. But if you went up to 8% of salary, they would match it with 8. And sometimes you're at 5 and you go up to 8 and they will stay at 5. So you just need to check the rules of your particular scheme before you start putting money into AVC, because sometimes what happens is you put 5, and if you put the other 5 into the main scheme, they would match that 5. Or you put the 5 into the AVC and they won't match it. So just double check to make sure you're not leaving something on the table there with your employer in terms of what they will pay into it. AVCs then tend to be, with the main schemes, the trustees would be very protective over them. Trustees are the people who kind of govern them or make sure that they're being run properly, and they're usually your employer and some of the directors in the company, but they would be kind of restricted of these are the things you can invest in. With AVCs, particularly if you do your AVC privately, you don't have to do it with the attached to the main scheme, you can do it privately. You would have much more investment choices in terms of where you want to invest your money and how you want to invest it. I did have a client in at one stage who explained to me that, yeah, there's an AVC scheme in work and I'd like to put money into it, but they were actually the shop steward. They were part of the union, and they said they don't want to have anybody in work knowing how much they're putting into their AVC. And he was talking about people from HR and everything else. Obviously, I won't say who his name is because you could get in trouble for that one. But what I would say is you can do them through the main scheme as an add-on to the main scheme, or you can do them privately. AVC, additional voluntary contributions, they were a great idea. The tax relief works the same, and if you're in that position, fair play to you, because it's a lot of people don't even start thinking about these things a lot later.
Okay, so Mary wants to know, what is the best way to gift my son a cash sum towards his and his wife's future mortgage? For example, the cash amount would be equivalent to 5% of the mortgage value.
Okay, it would be nice to know how much the mortgage value is. So if you want to give them money, I don't know if it's on a month-to-month basis. One of the things that's very underutilised is you can give anybody in the state €3,000 in any given year, and there's no tax implications for that. It's the annual gift allowance. And in fact, you could give €3,000 to him, and you could give €3,000 to his wife or his partner if you wanted to. You could give €3,000 to each of their kids if you wanted to, and you could use up that gift allowance. That might be a really simple way of doing it. One of the things we'd often do for clients is where they have got this excess cash and they're wondering, how do I pass it on to the next of kin or the next generation? What we will do there is, and next generation is the right word, not next of kin, but next generation. What we would do there is sometimes we'd set up a long-term savings contract. We'd put this €3,000 a year in their name every year, and we might tell them about it. Now, you have to make sure that it's set up right, but they may not be, what we do is over a long period of time, you put €3,000 a year in, 10 years, that's 30 grand gone in. Let's say it's grown to 35, and you can give them all of that €35,000 without any tax implications. They'll pay tax on the growth, but that's it. The alternative here is, and much more straightforward, is if you don't believe during your lifetime or at the end of your life when you pass away that you're going to be giving them more than €320,000, you can just give it to them, because anything up to that point is tax free. So you can give them up to you can give your kids up to €320,000 in their lifetime without any tax implications on it. So, and just be careful though, that's 320,000 in total from mother and father. It's not 320 from mother and 320 from father. It's 320 in total. So that might be the option depending on how much 5% of the mortgage is, which I'm not actually sure. So there's two options for you. Save it regularly or give them a lump now, provided the lump is in excess of 320. If it is in excess of 320, they're going to pay tax at 33% of it.
Okay, so this is the last question. So I'm a single 38-year-old earning 65k in the private sector without any pension. Roughly what monthly contribution do I need to start now? I know I'm years behind with it when I should have started a pension, but is there a name for the type of pension I should go for, and can I buy back years?
So the name and type of pension you should go for, it depends. This depends if your employer has a pension scheme and that you can join up to it, because then you're going to join the company pension plan. Or else if you're in what we call non-pensionable employment where you don't have a pension scheme, then you're going to take out what's called a personal pension plan and you're just going to pay into that yourself. You might also consider a PRSA, which is a personal retirement savings account, which is a bit similar to a personal pension. Don't get too caught up on this. Buying back years though is what I would say, it's kind of an unusual thing for you to come out with, because that's generally only got to do with the public sector workers. So buying back years is where, I don't know, you came out of college or you were working and you were still in training, say with a nurse or something, where you were still in training and you had a year or two where you hadn't joined the pension scheme with the HSE, and you can buy back those 2 years that you were in training where you were being paid but you weren't part of the pension scheme. That's what buying back years is. And I wondered, maybe if you are in the public sector, you do have a pension already, I would imagine, but buying back years is only available to people in the public sector. Don't get too caught up with it. The first thing to check is rule out buyback years if you're not in the public sector. That's one thing. The second thing is, does your employer have a pension scheme? And if they do, will they contribute to it if you do? And if the answer to that is no, then you can move on to PRSAs. PRSAs are your employer does have to facilitate, it's the legislation, they have to facilitate doing that through wages, and they will have designated a PRSA provider. They don't have to pay into it, but they do have to facilitate you paying into it. Some of the there might be some restrictions on fund choices, and failing all of that, personal pension is your next route. Sometimes the charging structures on personal pensions are better. Get a little bit of advice, see if someone will sit down and talk to you about it, but get the pension started. It's not too late. You're 38 years of age. You're all right. So that's it actually for today. Thanks a million for all the questions. We got lots in. There are some we didn't get to, but I'm sure we'll be here next week again. Thanks very much.